Our next guest is here to talk about the markets, but also about the second Trump administration's possible impact on fintech, the consumer, and IPOs. Joining us now is Nigel Morris, co-founder and managing partner at venture capital firm QED Investors and co-founder of Capital One Financial Services. Nigel, thanks for coming in.
Good morning.
To see you
Thanks.
this morning.
Morning.
Let's talk about this interplay of, policy, the markets, IPOs. It's interesting when you see how few IPOs there have been relative to the size of the market, given S&P's up 20% 2 years in a row. Technology's been the leadership sector. Is that because of anything going on with regulation, or is it just that the very largest companies have been where all the excitement and action has been?
Well, you're quite right that it's been actually a paucity of IPOs. In 2021, there were 61 fintech IPOs.
Okay.
And in the last 3 years, cumulatively, there's been 6. So it's been really not much happening there. The truth is, though, we have now a whole generation of fintechs that are now preparing for IPO. There's a number of companies that have filed their S1s. We have Klarna, we have Chime, we have Stripe that's very big that hasn't filed an S1, I don't believe. But these entities now are very profitable. They pass the Rule of 40 test. They're growing really well. They've got grown-up management teams. And I think they're all waiting now in the wings to see how the economy behaves itself over these next few days and weeks. Of course, this has been incredibly tumultuous the last 2 weeks, but I think we'll see in the first quarter the market being tested by these generation of fintechs. And I would remark that Service Titan went public 2 or 3 months ago, and their stock has behaved very well. So that's a good litmus test, I think, of how responsive the market will be.
Fintech is so interesting. I sometimes glibly say, like, either fintech doesn't exist or everything is fintech. Like Visa's fintech in some respects, JP Morgan's fintech. What do you mean when you suggest that there's some separate subsector called fintech?
You know, the way I think about it, Michael, is that you've got incumbents, the old traditional banks, and then you've got these innovators. And in some ways, Capital One was, I think, the first generation of breakout fintech now 30 years ago, and then followed by PayPal. But if you look at fintech, and this is a study that we've done with the Boston Consulting Group, fintech revenues added up worldwide represent $320 billion on a base of $14 trillion. So fintech, as measured by these attackers, these challengers, represents 3% of total revenue worldwide. So it's still very, very early days. And I think we're seeing, as I mentioned earlier, these companies now coming through that are real companies that have real management teams and are real threats to the incumbents.
One of the more clear potential policy movements seems to be lighter regulation on those traditional banks. I mean, that's what the market has sort of celebrated in advance. Does that change the competitive equation for these upstarts, or is it, it's still going to be kind of open season?
No, I think you're quite right. There's a very much a pro-growth environment from the regulatory front. We've seen the CFPB head move off stage and Treasury Secretary step into that role. And I think we're seeing a much more benign orientation in regard to financial service regulation. A CEO I was talking to yesterday said the gloves are now off in the deployment of AI across financial services. The CFPB had certain reservations about what you could do with AI, which I think, by the way, is alchemy. It's magical. But we will see, I think, less friction. We'll see more inclusion. We'll see more bank consolidation. I mean, we have 4,500 banks and 4,500 credit unions in this country, and 8,950 of them are subscale. So we will see that starting to come together.
Nigel, who benefits in this new world? Is it the big get bigger and bigger because they can take the AI gloves off, they can deploy more capital towards that, they can buy smaller competitors? Is it the new startups that are going to be able to run roughshod around that? Like, who wins in this environment?
Certainly in the shorter and medium term, my take is that it is the advantage fintechs. They're smaller, they're more technologically adroit, they can build these models out of the ground really quickly, both in terms of management of their costs and writing code. The incumbents will take longer. They will evaluate AI. Then they will determine where in the organization AI will be managed. And then they will have a vendor list that the organization can buy from. And then they will start experimenting. I saw a data point just the other day that said 16% of banks in the U.S. are experimenting with AI. Virtually every one of our portfolio companies, we have over 100 active companies worldwide at QED, virtually every one of them now is deploying AI at scale. And
so
any pitch that you hear from any company now starts with, here's how we're leveraging AI.
But so are the big banks. I mean, they're not just playing with AI. They've been investing and playing with it and using it at large scale, too. Do they buy all of those startups, the fintech startups that are there?
You know, it's been this has been an interesting phenomenon, how we've seen more fintechs buying fintechs and amalgamating them than we've seen banks buying fintechs. And I think there's a real schism occurring in the incumbents, where Capital One, JP Morgan, Citi, Chase, Amex, Fifth Third, Key, off the top of my head, are very much leaning in to looking at the fintech universe and saying, what can I buy here where I've got product market fit, I've got clear unit economics that make sense, it'll take me a long time to develop it myself, I will just buy my way in. Whereas I think the vast majority of the 9,000 banks and credit unions are still focusing on how do I buy things that look more like me and smushing them together.
But can't all these companies just tap the private credit market? I mean, when you look at IPOs, I understand why investors like you, private equity, venture capital, they want exits. But these companies, you look at the fundraisers by the big AI companies in the private capital markets, which are now a $2 trillion market, they don't need to go public. They don't need IPOs.
I think that's exactly right. We've got, over the next 2 days, I've got 15 of my portfolio companies off-site where we are putting together an IPO readiness seminar. These are companies that over the next 2-3 years, if the window's open, could plausibly go public. And a discussion there is, why would you want to go public? Here's some of the positives.
Costs, everything.
Yeah, you've got Sarbanes-Oxley. You're in a fishbowl. You are very focused on short-term earnings management. Your board will change dramatically. And the private markets are very vibrant, as you say. So I think that if we talk to our investment banker friends, they'll always tell you that it's a good thing to go public. Yeah. And of course, liquidity is an important thing, and that's been a huge issue in venture and private equity these last 3 years. There has not been that liquidity.